Hello and welcome to Talking Point. I'm your host, Neeraj Shah. And the case for a chat today, aside of all the macro conversation around rates and what it could do to multiples and elections, is this. Will management commentary about what could happen in the quarters ahead be a bit of an antidote to the slightly iffy fortunes of the FMCG companies and the consumer companies, at least the staples? Will ER&D as a space outperform IT services in FY25? It has done that very admirably in FY24 thus far. Is more steam lift in energy companies? Remember, we did this piece today on Editor's Cut when we spoke about the biggest wealth creators from COVID lows until March 31st, or until yesterday, if you will. And energy as a pocket stood out as a key wealth creator. I think the macro and the micro, we talk about both with our guest today, Shiv Puri, founder and managing director of TVF Capital Advisors, joins us all the way from Singapore. Shiv, always good talking to you, no less today. Thanks so much for taking the time out. I hope all is well.
Yes, all is well. Nice to be here, Neeraj.
Yep, thanks, Shiv. So, Shiv, just a quick word on the macros. There are a lot of factors impacting the macros: geopolitics, rate cuts, in India's case, elections. What is it, to your mind, that holds the biggest sway between now and the end of the year?
I think the biggest sway is got to be the direction of interest rates. And you've seen that, historically, when inflation spikes, it takes a very long time for it to settle. And that's proven to be the case this time as well. And as a result, when people expected a lot of rate cuts this year, up to 4 rate cuts were priced in the US this year, and now that's down to perhaps 1 or none. And so the direction of interest rates is going to have a crucial factor on what happens in the US economy, and also the direction that the Reserve Bank can take in terms of its rate cutting strategy. So I think the direction of interest rates will be the crucial factor for this year. With regards to geopolitics, those issues have been around for a while, and I think the market has taken that has accounted for it. In terms of elections, I think most investors and followers in India are assuming the outcome to have no surprises. So I don't think there'd be anything new that would happen in that.
Some chatter around if it's not really 400 par, but if it's lower, let's say if it's closer to 300, is that a disappointment for the markets? I'm just trying to think, Shiv. If the markets want political continuity, they get the political continuity at 275 as well. Would it be a disappointment indeed if the number is not very high, but if it is policy incumbency?
Well, as long as there is a majority that's expected, I think any disappointment would be very short-lived because structurally people will realize that the direction would be unchanged and there is stability.
Okay, fair call. Thanks for that. Now, Shiv, just wondering, what have you done with the India exposure currently? I mean, have you remained totally invested all through the volatility of the last, couple of or 2 or 3 months? And have there been weighted changes, even if you would have been fully invested between themes and between stocks?
Yeah, I think the long-term structural story of India remains unchanged. And it's been unchanged for the last couple of decades, actually. It's gone through swings, but the direction is clear. And with all that we've seen happen in the last decade, I think the next decade is also going to remain unchanged. I mean, I think one of the things that we realize now in the economy, many people are seeing this, is the compounded benefit of all the reforms that have happened and how certain sectors are benefiting hugely from it. So all of these reforms that happen, whether you talk about GST, whether you talk about the bankruptcy bill, whether you talk about the real estate regulatory reforms, et cetera, were piecemeal reforms that happened that caused some sort of disruption and pain to adjust to. But now that they're all sort of well understood, well in the machinery, the compounded benefits of things like that, including digitalization of the Indian economy, payments, et cetera, all of the benefits that are started to compound in the years ahead. And I think the benefits of that will come on. So I think macro-wise, things are looking very solid. Near-term fluctuations will happen. Areas like banking, areas like healthcare, especially hospitals, certain pockets of FMCG, or I should say consumption, not FMCG, continue to look very, very interesting structurally.
Okay, and we're going to talk about this in detail in a bit as well. But Shiv, we're doing this morning, taking a leaf from an IIFL note, looking at the wealth creation that has happened since COVID lows, and a much more widespread a journey. I mean, the number of stocks which have really gained from 5x to maybe 100x. That number has been very wide. It is not concentrated in the quality names. It's been across sectors as well. Maybe energy stood out, maybe economy-facing sectors stood out. It was quite unthinkable back then during COVID lows that anything but tech and quality will do well, and certainly some of them have. I'd love to understand from the economy-facing things, and I want to start off that topic in this segment. We'll come to consumers in the second segment of this conversation. From the economy-facing space, Shiv, how constructive are you there? Is the portfolio tilted towards domestic economy-facing companies, or are you still not quite there? And what within that bucket do you like the most?
Yeah, so I think to your first point, you're absolutely right. The Indian equity markets behave quite differently than the US equity market, where the returns have largely been driven by the big tech stocks. It's much more broad-based in the Indian equity market, and that's healthy. And it's not surprising, given that the growth has been fairly widespread across sectors. I think the interesting investment areas in India have always centered around the domestic economy, whether it's consumption, whether it's infrastructure, whether it's financials, all catering to the growth that's there in the Indian domestic economy. So I think that remains unchanged. And I just highlighted some of the areas that I thought remain interesting, have been interesting, and likely to do so.
Okay. The argument being made by some people, Shiv, is that, let's say, for example, capital goods, which will be beneficiaries of a capex cycle which is underway from the PS government side and maybe from the private side soon, are great beneficiaries, but some of the high quality names out there are priced to perfection or beyond perfection. I mean, the ABBs, the Cummins, etc. of the world might see selective upgrades or downgrades, but largely the belief is that they are well priced, and therefore the money-making opportunity remains not necessarily in the high-quality names, but in some of the others which will benefit because of a valuation re-rating. How do you think about this argument?
I think one has to be very careful with an argument like that, because see, some of these high-quality names that you mentioned that have re-rated have also had a change in their business model, right? Some of them have become much more services-oriented than low-end manufacturing, and it's reflected in the return on equity, the return on capital ratios that you see for some of those companies. So for that reason, along with the growth tailwind, some of them would command a higher multiple than perhaps in the past. I think the important thing in capital goods is that all revenue and all earnings are not equal. There are certain companies that will benefit because you have a tailwind, but are very competitive market spaces. Capacity will come online, margins will get squeezed, and the earnings trajectory, which is being straight lined into the future and a very high multiple that's being put on that, might actually see the opposite happen over there. So one has to be very careful in terms of extrapolating, simply looking at the PE ratios and look underneath and see what's the durability of that growth, what is the barrier to entry, what's the model, in terms of return on capital metrics, and just the usual things that one would look at across the board to make a decision on that. So I think, infrastructure, even in past cycles, capital goods in past cycles has been very cyclical at the low end. And so again, to be sure, one has to be careful not applying a multiple to high earnings, a high multiple to high earnings, because that can set up for disappointment.
Okay, that's a fair call. Some of the economic spend-linked sectors, Shiv, have gotten formed only in the recent past, right? And some of the PLI beneficiaries, new energy, all of that is People are still wrapping their heads around at least the new energy, green hydrogen, whole ecosystem, data centers, etc. Are maybe a bit more mainstream now, but they were also new about maybe a couple of years ago. From within railways, for example, or the resurgence of defense, if you will, from within all of these that have just come in, and I know you look at it from a different lens, sitting out there where you are, I'm just trying to understand what is appealed to somebody like you from this theme.
Yeah, there are certain segments in infrastructure and capital goods where the demand cycle looks to be very structural for a long period of time. And you mentioned railways. That's certainly one area that it looks like it's going to happen. And then, so therefore, supplying into components that supply into some of those markets would be very interesting. But again, one has to see that nobody's sort of looking at the commoditized aspect of companies that supply into that region. I think the one other point to keep in mind is we talk about, say, green energy, etc. Sometimes these are very good for the overall economy in terms of promoting growth, lowering the cost of power, working well with the environment, etc. But by themselves, they may or may not make great businesses. We see that in payments, for example, right? Digital payments is a great lubrication for the financial services industry. I think it's done a lot of good in India and in help promoting businesses. But it's not necessarily maybe the great way to sort of create wealth. It's a very difficult business to make margins and to make money. So again, I would say there's certain areas within capital goods that are very interesting. Several areas great for the economy may not necessarily be great as investment themes.
Okay. Before we take that break, though, Shiv, something that has found newfound resurgence, you would have taken note of the Vodafone FPO and the resultant RARA moves in telcos. I would love to think, how are you thinking about this? It's a sector that has been in news all the last few years. Is this time different?
Yeah, well, for the longest time, there was a player in the market that had, very aggressively acquired a lot of customers. ARPU levels were low compared to the services that they were being offered. It was a great benefit to the Indian consumers. And I think as that stabilized, it becomes quite clear it's effectively a 2.25 player market. And I think maybe some of the bets that are being made on the quarter player on Vodafone is that maybe it'll become a 2.5 player market or a 2.75 player market. I think time will tell, because this is a business that is very capital intensive as well. Barriers to entry are very high. Scale matters, and the top 2 players in the country effectively have a vast majority of the subscriber base already locked up. So I think it's very up. It's up in the air to see whether the quarter player can become a half player or not.
Would you bet on it?
No, I think it's very difficult. Again, I don't know what happens from a short-term perspective, because that particular company's stock has had fallen a lot. So again, no idea on what that's going to do. But fundamentally, given the construct, if somebody has a more structural view, it's a very difficult bet to make.
Okay. Well, we'll try and talk about structural stories. Shiv Puri is talking about consumption, and I think what we'll do is we'll try and talk about that in detail. Remember, the first of the FMCG numbers came out yesterday in Tata Consumer. Some more up this week as well. We'll try and focus a bit on that and how does Shiv think about that consumption space, both staples as well as premiumization. Stay tuned, we'll be right back. Back with Talking Point right here on NDTV Profit in conversation with Shiv Puri. Now, before we go to him, let's get in a word on one of the key losers today. Tata Consumer Products came up with Q4 numbers yesterday, of course, post-market hours. And while the top line growth and PAT numbers missed street estimates, the margins expanded a little bit. Mahima, my colleague Johnson, to share some perspective on the quarter. Mahima, good morning.
Good morning, Neeraj. So as you rightly mentioned that the revenues and PAT have, missed estimates. However, margins have shown some kind of improvement. Now, a couple of reasons why the stock is under pressure. The major thing is that the volumes did not grow as much as they were expected. The beverage business grew only by 3% in terms of volumes, which usually grows around 8 to 9%. And overall, also like-for-like volume growth was only around 4%. Now, PAT has beaten street estimates. Now, this is only because of a one-off exceptional loss of around 216 crores, which was majorly related to the cost of acquisitions that they've recently made. Now, in terms of the international business recorded a good growth of around 7%. In terms of their premium segment, they account for 2/3 of the revenue. So something their growth business has performed well. And in terms of their branded and overseas business is something that has taken the EBITDA margins upwards. EBITDA margins is also done well because of the non-branded coffee business margins. And in terms of despite of all of this, the board has recommended a dividend of around 7.75 per share. So this is the overall view of how you can make out from the results of Tata Consumers.
Brokerages sanguine, Mahima, very quickly.
Absolutely. So a mixed view in terms of brokerages also. Something like Nuvama is extremely bullish on Tata Consumers. They're saying that their innovation business and something that the product innovation that they're into is something that is driving the stock and which will further add growth to the company. So mixed views in brokerages, but Nuvama is something that is really bullish with a target price of around 1400 per share.
Yeah, thanks Mahima for that. Some of the others not too sanguine. Shiv, a Tata Consumer or an HUL or a Nestle, all of which come out with numbers. You spoke a little bit about consumption. I'm divvying it up into two: staples and then the premium consumption players. In staples, is there a case being built for a slightly better FY25? One, FY24, the base will hopefully help growth numbers in FY25. And two, the valuations, though not very cheap, but have corrected from the peak of October 2021.
Yeah, I think, what we're seeing in the last couple of years is this sort of two-step consumer economy. You're seeing an aspirational consumer economy on the one hand, and then you're seeing the regular consumption economy on the other hand. And on the aspirational side, you're seeing very strong growth, whether it's premiumization, whether it's spending on discretionary items, whether it's travel related, so discretionary services. All of that has been very strong. And the regular consumption side, I think, is still going through a challenging environment, primarily because of the inflationary impact that consumers have felt post-COVID. So real incomes, at that level have not kept up with the pace of price increases that we see many of these companies do regularly. And they have to increase prices just given what's happened to their raw material costs. And so volumes naturally are not moving in as they used to in the past. I think this still continues for a little while because we still are seeing demand at that level, whether it's urban or rural, be quite slow. And the real incomes have to first move higher before consumption of goods in that level can move higher.
Okay. The premium end of the market, Shiv, some great gains, right, for businesses like Ethos, Landmark, a clutch of others, which are all centered towards the urban upper crust consumption. Some of the retail plays as well doing so well. Has that slice run its course, or do you think it's a multi-year theme and can last? And if so, within those sub-buckets, what are your favorites? I mean, could it be a watchmaker? Could it be a car dealer? Could it be a retailer? Could it be something else? Or a jewelry company for that matter, whatever.
I think the opportunity that you describe here is multi-decadal, because what we're talking about, urbanization, may not just be the top 8, 10 cities, but another 25, 30, 40 cities that are in the pipeline, which are also getting urbanized very fast, where the penetration levels are much, much lower. And so whether you talk about whether it's in the jewelry business or retail, I think it's really important to understand whether the business is the right structured correctly, it has the right model, it has scale, it has differentiation, it has proper sourcing, and it's basically got the fundamentals of a sound model. But the opportunity set, I think, is multi-decadal in that space.
Shiv, what is your largest overweight currently in the Indian landscape? Where is it you have the largest overweight from a theme perspective?
Well, at this point, in terms of themes, I think financials is an area where there is quite a lot of focus. And I think, if you look at some of the private sector financials that haven't done well over the last few years relative to the rest of the market, have gone pretty attractively priced. And I think the growth numbers have been reasonable. Liquidity undoubtedly is tight. But I think what's going to happen going forward, even with a slight pickup in asset quality in terms of NPAs, you will see a softening of rates over time, and demand will continue to remain strong. Plus, they're very attractively valued.
So banks, you're looking at private banks?
Could be private banks, private financial services, NBFCs.
Okay. And not PSU banks?
So historically, not much is done in the PSU sector. So that's been something. There has been a pretty sharp rating in the PSU banks, as we would have seen. I will say this, though, I've been quite impressed seeing some of the changes that the larger PSU banks have made, both in terms of management quality, as well as the development in technology, which they used to be fairly behind. Very impressive what's been happening in the PSU bank at a fundamental level. But I think a lot of the re-rating seems to have happened.
Okay. Final question, Shiv. The debate around valuations for Indian markets is a perennial one. I mean, I've not had a year wherein people haven't spoken about the markets being expensive, save for maybe during the COVID times. Even then too, it used to be the case. I'm just trying to think, how do you think about this when you're making an investment decision?
Well, when I started looking at markets here in 2004, I remember in 2003 when I was in the US, at that time, the prevailing consensus was the Indian markets are too expensive. And you're absolutely right. 20 years later, it's still the theme. And I think it's important to understand that duration of growth matters. And that's what the last 20 years have shown. If there's a company or a country where the duration of growth can be pretty long, multiples will naturally remain higher, as they should. So I think that is something that is going to happen. Now, in certain pockets, it is maybe irrationally high. You're certainly seeing that it happen in some of the mid and the small caps, where the quality of earnings in some of those companies may not be deserving of the multiples that they are getting. And that might be a function of a lot of retail capital or whatever it may be. But by and large, if you look at the well-run companies, the larger cap companies, some of them may be at the higher end of the range, but many of them still are in the zone of valuation that they have historically been, for the last 2 decades. And so the real question is whether will growth sustain? And we feel it will.
Okay. Growth will sustain, and that should help. But the duration of the growth being a very important part as well. And if that continues to be high, if the market believes that continues to be high, then the valuation multiples may well catch up. That's the perspective from Shiv Puri. Shiv, great having you as always. Thanks for taking the time out, and have a great remainder of the day.
Great. Thank you for having me.
The pleasure was ours. And viewers, thanks for tuning into this edition of The Talking Point.